Hey, it's a great privilege, obviously, to have Mohnish back on SumZero. Mohnish, you're a bit of a value investing legend. You've got Guy Spear here, who's himself very well known in the community. Kind of itching to hear what you've got to say. In the past, we've chatted. I guess this was like last summer. I forget exactly where we kind of went through a whole bunch of um, sort of different themes, big tech being one of them, Turkey being another one. And so I guess we can start with Turkey. Obviously, super tragic what's going on there right now. It seems like every time I open up a web browser, I see like the death toll rise by a few thousand. It's yeah, it's just kind of hard to believe. But you've been an investor in Turkey. You've been to Turkey, you visited it. I'm assuming you've spent a decent amount of time there by this point. Um, maybe just first off, like before we even get into Reysas, do you have any just sort of reflections on what's going on there recently? If you have any thoughts, feel free to sort of share them with us.
Yeah, I mean it's very tragic. I think the death toll numbers, and one thing that disappointed me in the media is that we keep seeing the death toll rise, but what they don't report is the number that are missing. And the number that are missing will unfortunately eventually approximate the actual death toll. I mean, we are going to see some miracles, and I hope we see a lot of miracles. But it's been more than 3 days, and so as the time goes by, and the missing, my friends in Turkey tell me, could be as much as 100,000, and
Wow.
so it's a very large number. What I would just say is that SumZero has been very generous to Dakshina. I would say that anything you're planning to do this year for Dakshina, you should redirect to Turkey, to the relief efforts. And if it comes to us, then we'll redirect it anyway. So, and also the same to your viewers, I think, to the extent that they are thinking about Turkey, I would say think about the relief efforts and such, and any way we can help, because it's a serious human tragedy, and I don't think the scale is known yet, but it's really bad.
Yeah, I think that makes a ton of sense. And we'll certainly follow up with you on that. So
Yeah, I think
you know,
that the Turkish market, they closed the market until the 14th, because it was so in Turkey, basically stocks can go up or down at most 10% a day. And for a couple of days, they hit the 10% lower limit. It didn't really matter which stock it was. I think almost the whole market was hitting the lower circuit, even though a lot of the companies are not directly affected or may not be that affected by the tragedy. And so I think the regulators felt that, give it some time for people to not do panic selling or whatever else.
right.
But when the market opens up on the 14th, prices are likely to be more attractive than they were a few weeks ago.
Yeah. Well, it's a good thing we have Guy on the call here. One of the questions that one of the listeners had for Guy, which is sort of a philosophical one, is how do you think about investing in certain, getting comfortable investing in certain countries, and to the extent values may be different from the West, whatever, people have lots of different views on this. Guy had at least previously sort of passed on Reysas, even though he knew you were invested in it, just because he wasn't as comfortable with the region, the jurisdiction, governance, things like that. So just taking a step back, we've talked about Reysas before as being just the way you described it is sort of an unbelievable value. But how did you personally just kind of get comfortable with Turkey as a market? What was it that kind of helped you get over that hurdle?
Yeah, I mean, I think in investing, we're always going to be looking at a number of different factors around an investment. And one of the difficulties that comes up in investing is what weight we give to those factors and how we think about them. So if I go back to 46 years ago, 1977. So 1977, uh, Charlie Munger got a phone call from a friendly broker offering him 300 shares of a company called Belridge Oil, which was a large oil field in Bakersfield, California, for $115 a share. And Charlie said, "I'll take it." It was a very thinly traded, pink sheet stock, and that was about $35,000, and he made that investment. And Charlie knew from what he knew about Belridge that it was probably trading at 10-15% of liquidation value. It was really cheap. And 2 days later, the broker called again and said that he had another 1,200 shares at the same price. And this time, Charlie didn't have the cash. And so he would have to either sell something or borrow the money or something. So he told the broker, "I'll call you back." And he thought about it, and he decided to take a pass on those second 1,200 shares. So the first 300 shares, Belridge had a market cap of about $115 million in 1977. And 2 years later, 79, Shell Oil bought the company for $3.6 billion. It was about a 30x plus the very fat dividend that he collected for a couple of years. And so his 35,000 became about $1 million in 79, which he then proceeded to put into Berkshire at approximately $300 a share, which is now close to $500,000 a share. That's about a 1,500x. And so the million today is about $1.5 billion. And so the 35,000 became about $1.5 billion. It's about a 45,000x over that period. Now, Charlie says Belridge was his biggest mistake because the 1,200 shares that he chose not to buy, that he knew were worth at least 5 or 10 times what they were being offered at, would have given him about another 4 million in proceeds, and that would have converted in about 6 billion and counting into Berkshire shares. And he said that, the CEO of Belridge was a bit of an alcoholic. And so he said that he knew the oil field was spectacular. And actually, this was an oil field that actually they owned all the rights, which is very unusual. They owned it into perpetuity. Just to give you a sense of what happened with Shell from 79 till today, Shell has pumped out and collected more than $60 billion from that oil field since 79, buying it, and it's still pumping. It is still producing oil for them. So it's a very prolific field. And Charlie knew that. So he said, when he reflected on Belridge, he said the oil field didn't drink. Okay, he said it was the CEO who drank, and he needed to, what he didn't separate was the oil field from the CEO, right? And so basically, he said, I overweighted the CEO's alcoholism, and I underweighted the basic economics of the field, which you couldn't really screw up whether the guy running it at the time was alcoholic or not. So when we look at Turkey, obviously you're going to see macro issues. You're going to see, very high inflation. You're going to see monetary policies that don't make sense. You have all these things going on at a kind of high level over the country. But then, when you look at individual businesses, so let's leave Reysas aside for a second, and let's talk about the Coke bottler in Turkey, because that's a business that everyone will be more familiar with. I think you can understand what the bottling business looks like around the world. It's very similar. So the Coke bottler in Turkey has an exclusive right to sell all Coke products in Turkey. Not only in Turkey, they're in 12 other countries, including Pakistan. So they do all the Coke bottling and sales in Pakistan. They own 49% of the Pakistani Coke bottler, and the Coca-Cola company in Atlanta owns 51%, which they probably in the next few years will sell to the Turkish company. And Coke sits on the board of the Coca-Cola bottler in Turkey. It's Coca-Cola ISIC. So Coke owns 20% of that business, and they sit on the board of that company. And basically, when Coke has bottlers that come up in the region, for example, they had one in I forget, I think it was Turkmenistan, one of those Central Asian countries where the government was the bottler, wasn't doing that great. And basically what Coke did is they arranged a sale to the Turkish company, and they even subsidized the sale for them. So they are so I would say that when we look at the Coke bottler in Turkey, and you look at another Coke bottler, in Europe or in somewhere in the US or Latin America, they are very similar businesses. They have very similar economics. And unless Turkey did something strange, like, put capital controls or something else, these businesses should be valued very similarly. But they are not. So the Coke bottler basically, trades at barely hitting double-digit multiples now. And it used to be less than half the price a year ago, trading at 4 or 5 times cash flow. And so when we look at businesses in places like Turkey, and I met them twice actually. The Coca-Cola bottler company in Turkey, and there's a video I had done a few years back, a talk at UC Irvine. It's about 2 hours just on the Coke business model, and I asked them to look at that video, which they did. And when I met them the second time, they didn't really want to talk to me about the merits of investing in their company. They really wanted to pick my brain on the strategy they should adopt, which was kind of fun. So they were actually asking me a bunch of questions about, different folks in the road and what they should do and so on and so forth, which was good. But that business is owned, the promoter of the business in Turkey is one of the highest quality families and management teams in Turkey. They have 2 other listed businesses. They have a beer business, which they have 50% market share. They have a very dominant supermarket. All 3 businesses are very high quality. The people that I met running these businesses were the highest quality management team of any team I met in Turkey. They were exceptional. Some of them had Ivy League educations in the US. The CFO of the Coke bottler used to work in Atlanta for the Coca-Cola company. He then worked in Delhi for the Pepsi bottler. I mean, he'd been all over the place. He's actually Ukrainian. He's not Turkish. So I found with that particular company a great management team. I found a monopoly business, or a duopoly business, you could say, in terms of the dominance of the brand. And then you have the overlay of Turkey. So I think that when you, as an investor, look at these things, it's important that you weigh the factors correctly. And there is some weight that you should give to the fact that it's in Turkey. But to say that I'm going to reject it because it's in Turkey is like Munger saying the CEO drinks too much. So I think this is one of the interesting things about investing is that we don't usually get pure, pristine bets that we can make. There's always some hair on them. We talked, actually, time flies, but the last time we spoke was about a year ago. I know it seems like it was shorter, but when we spoke about Meta, even a business like Meta, there are very great aspects to the business, and there are some not so great aspects to the business. And, you have to weigh those factors, and we won't always get it right. But the more rational we are in looking at those factors, probably the better decision we end up making.
Yeah, Mohnish, the interesting thing about you is that you're known for taking pretty concentrated bets, and you're also known for holding on to positions without any kind of like hard line or bright line cap in terms of, a lot of times people are, oh, well, this stock's now 10% of my portfolio, I better sell it so it's back down to 5% or something. Like, as far as I understand it, you're not of that school of thought. So when you were looking at Reysas from a weighting standpoint and trying to handicap it for the fact that it is in Turkey, how did that affect your position size?
Well, the problem I had with Reysas was that when the day I met them for the first time, the market cap was $16 million. So no matter what I tried to do, at that time, we were managing around 700 million. And I ended up, by the time I finished buying the position, I ended up owning about a third of the business for 7 million that we invested, 7 or 8 million. And so I didn't want to make it a 1% bet. I ideally like to make 10% bets, but there just wasn't an opportunity, on a $20 million position to put 70 million into it. I couldn't do that. And so now Reysas, since then, I mean, now with the earthquake, it's dropped a little bit, but it's, hovering around 250, 300 million now, so it's moved up a bit, but their liquidation value, which used to be about, 6 or 700 million when I was making the investment, is probably north of 1.5 billion now. So that's also moved up quite a bit. So it's no longer at 2% of liquidation value. It's probably more like maybe 20, 25% of liquidation value, something like that. And it's not the liquidation value that really interested me. What interested me was that this was a company that was extremely smart about reinvestment. The father-son team that run the business, they really don't want to make investments if they're not getting the money back in dollars in 2 or 3 years. And so their reinvestment hurdles are 25 to 35% IRRs. And they're very creative. They've entered a number of businesses in the past, which they weren't in. They start small, get competence. And so they've, moved into a number of different businesses, and they've gotten scale in those businesses. I didn't even value all those other businesses because those were harder to value. All the numbers I gave you is just for their one real estate business. And so if a business is reinvesting at very high rates and, the leadership is relatively young, my take on Reysas was that we're going to let this ride for about 20 years, it might be 10, 20 billion, 30 billion, who knows what it is in 2040 or 43. So just leave it alone. Now, if I look at my funds, in one of my funds, the offshore fund, there are 2 bets in Turkey that collectively made up about half the fund. Not because we put half into it. I mean, one was Reysas, which went up, and the other was TAV Airports, which is another great business. And we've, for the most part, closed the fund to new money coming in. And I told my investors, look, it's very concentrated. We're not going to lighten up because when we look at what we own, they're very cheap and very good assets. And even if it gets to 80% in these 2 stocks, we don't plan to lighten up. So I told them that if they don't like that approach that I'm taking, they can get off the bus and they can redeem and move on. But I'm not going to change my perspective on that. So the way I look at it is that, if you look at the Walton family and the ownership in Walmart, Sam Walton's passed away a very long time ago. And no Waltons are really running that business. There's only one Walton on the board. They don't have control of Walmart. Most of them have kept the stake. And for most of the Waltons, the Walmart stake represents, vast majority of their wealth, probably in many cases, more than 90%. And so you would say that's not diversified, but if you talk to them, they would say it's perfectly fine. They're very comfortable with that. So the way I look at Reysas is we are not the founder or the promoter or the owner of the business, but we can think of it like that. And so, or if we own the Coca-Cola company's bottler in Turkey, we should think of ourselves like a minority owner. And if we were a minority owner of a high quality business like that, we shouldn't even sell it if it gets fully priced. We should not even sell it when it gets overpriced. We should sell it when it's egregiously overpriced. If Walmart went to something like, 100 times normalized trailing earnings, yeah, maybe the family should look at selling. But at 40 times, 30 times, 20 times, it's a good idea not to do anything.
Just because you think the earnings will continue to compound and that multiple will compress over a longer time horizon?
There are very few businesses in the universe of listed companies that would qualify as great businesses. Probably, I would say less than 5% or 3% of listed companies would qualify as great businesses. If you find yourself in the very happy situation of fractional ownership of one of those businesses, hang on for dear life. And this is one of the biggest mistakes I've made over time. Guy owns a stake in Ferrari. Thanks to Mohnish. Thank you, Mohnish, for giving Guy the Ferrari stake. And Mohnish doesn't own Ferrari. And when I made the investment in Fiat Chrysler in 2012, when the market cap was 5 billion and their sales were 140 billion, Fiat Chrysler was trading at less than 4% of revenue. Okay, it was just the equity was, and 80% of Ferrari was inside that 6 billion. And plus there was all the, Jeeps and Ram and Maserati, everything else in there. And at that time, Pabrai funds owned something north of 1% of Ferrari. When I looked through the Ferrari stake. And we made a lot of money on that investment. And one of the dumbest things I did was Ferrari looked optically expensive to me. And I sold, and we would probably have 3 times that amount of money if I just kept the position. And so, like Charlie says, old too soon and wise too late. So one of the lessons I've learned the hard way is that, very few businesses have the characteristics a Ferrari has. The higher the price of the product, the greater the demand. They recently released their SUV, which they don't even want to call an SUV. It's going to start at 421,000. You're not going to be able to get one for 421,000. By the time you option it out, it's probably 600,000 or something. And you can't get one at 600,000. They're all sold out. And so if you actually try to buy one from someone who's got one, you're probably going to spend over $1 million on that. I mean, that's an incredible business.
Yeah,
80% margins.
I was a little annoyed by the SUV, but I know they had to do it. So putting aside Ferrari for a second, so do you still own a third of Reysas? Is that roughly kind of your stake at this point?
I hope I go to my grave with it.
Yeah. Do you feel like as a large shareholder or minority shareholder that you have some say in terms of how again, getting back to corporate governance, I mean, do they see you as sort of an equal or close to equal?
Yeah, I have a good relationship with the founders, and in fact, last year they came to Omaha for the Berkshire meeting. The son did, which was excellent. I thought that might help them in their journey to understand Berkshire more. And Buffett says that if they need my help, we're both in trouble. Basically, I think that if I'm a lazy guy, Divya. I really don't want to serve on boards. I don't want to be telling companies. I mean, the management team at Reysas can run circles around running that business better than I ever could. And I don't think I could come up with any strategy that would be superior to what they are doing.
Yeah.
And basically, I think that business works because of the incentives the team has. And so I am happy to be a cheerleader on the sidelines. And I don't have any desire. I haven't seen them do anything dumb in 15 years.
Wow.
I just see one smart thing after another. And these
What
are
was the who was
much smarter than I would have done if I was running it.
yeah, who was the broker that you used to build the position in the first place?
So Turkey is difficult to access. You can access it if you have a prime broker relationship. We use UBS, but I think any of the major prime brokers would be able to get you access to Turkey. For retail investors in the US, there is only one way that I'm aware of to invest in Turkey, which is through Fidelity. And so if you open an account at Fidelity or an IRA or whatever, and you can't really trade it on their platform, but you can call their international desk and kind of place trades on the phone with them. And they have its higher fees. I think it's $80 or $90 per trade, and there's like a FX conversion fee and all of that. So there's some frictional cost, but it's still okay.
And speaking of FX, I think you mentioned this to me. You mentioned this to me via email, but the lira obviously has had a tough time over the last year or so. You don't, as far as I understand it, you're not hedging FX at all, right? You just
No, I
own
mean,
the
I think Reysas has gone from the 16 million to the 250 odd million in dollars over the last 3.5 years. I don't even know how much it's gone up in lira. Probably 4 times that. And
yeah.
and the lira was 5 lira to the dollar when I invested. It's now approaching 19 lira to the dollar. So we lost 75% of value in the lira. It was not relevant to me because I knew that the asset was automatically inflation indexed, because a warehouse is steel, iron, concrete, cement, land. All of these things are going to move with inflation. And so basically their rents are inflation indexed as well. And some of their leases are in dollars or euros. So basically there was really no reason. And these are the only investments I'm interested in Turkey. So even when I look at the Coke bottler, they have the ability to raise prices, to keep lockstep with inflation. So I don't expect inflation to have a big detrimental impact on their business.
What was
So
the other?
there's no need to hedge the lira if you are invested in a sliver of the companies in Turkey that are unaffected by inflation.
What was the other Turkish name that you're bullish on?
It's TAV Airports, TAV, and TAV is another wonderful business. They have 15 different airports in 8 countries. And the airport business is a fascinating business. It's a complicated business actually, because it's like 10 businesses in one. But these are very favorable economics if you don't overpay for the right to run the airport. So typically with airports, what happens is it's a BOT model, build, operate, transfer. So you will get a 25, 30, 50-year concession with some airport where you say, okay, I'll build a new terminal, I'll do the XYZ, I'll give the government $500 million. And against that, I get the right to run the airport for 30 years or 50 years. And there are portions of the revenue that are regulated, like the passenger fees and all of that. And there are portions of the revenue that are not regulated, like duty free and food and beverage and that sort of thing. So when you blend it all together and you look at the economics, especially if you don't overpay for these things, it's a monopoly asset. It's a cash cow. It's just, and in the case of TAV, they have a very unusual situation. They acquired one airport during the middle of the pandemic when air traffic was close to zero in Almaty in Kazakhstan. Almaty is the largest city in Kazakhstan. And that was an outright purchase. It is the only airport I'm aware of in the world, major airport, that's privately owned forever. So this wasn't a 30-year, 50-year concession. It's a permanent concession. They own it permanently. And that's a very unusual situation. And that deal, which got done when there was no traffic, there was $400 million for the airport and another $250 million for the capex. They're building a new terminal. Just that airport alone in 2026 or something is going to be cash flowing north of $200 million a year. It's going to be increasing that cash flow close to 5 or 7% a year from there on, almost to perpetuity. And it has no competition. And Kazakhstan is landlocked. It's actually got a very high per capita income. I mean, basically, it's an asset that was purchased for 3 times cash flow. And airports like that should trade at 30, 40 times cash flow.
Really interesting.
And something like that would not be available at those type of prices on the New York Stock Exchange.
Yeah. So this is another airport or asset that you could see yourself owning for 20 years?
Again, extremely high quality management team. You know, like I said, I mean, I looked at the business. I thought it was an exceptional business. The risk you run with airports is animal spirits. So when some new airport comes up for bid, if it gets competitive and people are not willing to lose it and they overpay, then it's not going to work well. So that's always the risk with, I think that's the biggest risk with TAV, is there will be only about 4 or 5% of the airports in the world are private. And privately run airports run a lot better. You know, LaGuardia now is a private airport. And you look at LaGuardia 5 years ago, you look at LaGuardia today, and you can't even compare the two. And that would not happen under government ownership.
Mm-hmm. So moving beyond Turkey for a second, you've been in the news a little bit about recently about your investment in Brookfield. Is that something you can speak to a little bit?
Well, I mean, we have an investment. I don't think we have anywhere near the upsides we have in places like Turkey, a company like Brookfield.
Yeah.
It's a very high quality business. It's a very high quality team. They actually give you, kind of 5-year outlook on what they expect their business to look like in 4 or 5 years. And they've been doing it for a while, and they were actually exceeding what they set at their targets in the past. So if the management team is to be believed, and if we buy into their targets, it'll be a great investment. And it's Brookfield is a very strong recurring revenue business. It's got multiple facets to the business. One side is asset management, where they have other people's money that they're putting out to work and getting fees and such. They also have their own balance sheet where they co-invest and so on. And they've got minority stakes in other companies they've listed in the past and so on. And they've just got the quality of the assets that they own across different industries is truly exceptional. I mean, they've gone after the very best real estate properties. They've got great hydro plants and railroads and a number of different interests. Recently they did a deal with Intel to partially own foundry that they're going to set up together. And they've also now entered the music business, the music licensing business, and such. So I think it's a very good team. I've always liked Bruce Flatt a lot, and so yeah, we have a stake, and we think they'll do fine.
Why Brookfield over, say, a Blackstone?
Yeah, so I think you could probably buy a basket of these and do well. I think if you bought Brookfield, Blackstone, KKR, Apollo, all of them, if you just put them all in a basket and bought them, they would all do well. I think Brookfield may do better than the rest, mainly because of the DNA differential between them. So if you look at KKR or a Blackstone, they come from a private equity world. If you go back to the history of the original kind of funds and deals and whatever, it was a classic LBO private equity type starting point. Brookfield's starting point actually goes back a long way, several decades, and they really were not a manager of other people's money. They were really investing their own money, And when Bruce Flatt came on the scene and became CEO maybe more than 2 decades ago, um, he got rid of all the businesses which he didn't think were that high quality. They were in a bunch of mining and different things. He got rid of those businesses, and he focused on extremely high quality, long lived infrastructure assets. And the private equity world, generally speaking, because it's so competitive, uh, has not recently and even historically has had very high filters on the quality of the business. They always felt that they could buy a mediocre business, do some financial engineering and still make a good return. Brookfield didn't take that approach. Their approach was that at the core, they want to have a great asset. And then later they want to look at what, how they can finance and do other things with it to make it great. So I think the KKRs and Blackstones of the world have moved towards Brookfield in the way they think about it. But I think that when I look at just, long-term DNA of how these companies think, I just think that Brookfield just from day one had the right DNA.
Was there anything about sort of the valuation of it that appealed to you? I mean, how do you just kind of think about it from a pure valuation standpoint?
Well, I think it's not optically cheap. None of these guys are optically cheap. They're not expensive either. But I think if you look forward, so if you're a sovereign wealth fund, let's say you're like the Qatar Investment Authority, Abu Dhabi sovereign wealth fund, and so on, uh, you have very large amounts of money to put to work, and there are very few entities or places that you can put this capital with, which are very high quality places, very high quality teams, and they can be there with them for a very long time. So it's an oligopoly type business where there are like 3-4 players that all these guys have to come to. At the end of the day, when they want to invest, they have to come to one of these 3 or 4 toll bridges to make the investment. And so the assets under management they have is going to grow a lot. The carried interest is going to grow a lot. The fees are going to grow a lot. And they are creative about entering new areas like music or, semiconductor foundries and so on. So it's fine.
And has the work from home trend affected them at all? Or if I mean, maybe a little bit.
Yeah, I think clearly, trophy. I mean, I would say office properties in general across the world are facing much higher vacancy rates than they did before because of this trend. And so obviously the demand has gone down because Brookfield sits at the very top end. So they've always wanted to invest in tier 1 cities in the very best properties, the kind of the trophy properties in these, like Brookfield Place or Canary Wharf and so on. And so these would be the last ones affected, and so their rents will go down, but the ones at the periphery will just have high vacancy, whereas the trophy properties will just have lower rents. And so, yeah, I think they've got they have some challenges with their properties, but also, these are long leases, so it takes a while. So even if a tower is, got a lot of vacancy, Brookfield may still be collecting rent on it. And like, for example, Meta has a big, the largest, the tallest building in Austin now. They signed a very long lease for that, and it's still not going to be ready for I think a year or two. And they've already, put it all up for sublease. So they're on the hook for that rent. But whoever the landlord is not affected by Meta's decision that they don't need that space.
Yeah, they what do they take like a $2 billion charge last quarter just on office consolidations.
Yeah.
So no, we actually have a guy who's going to be speaking about alts later in the session. to talk about Apollo, but some of these other names as well. So it'll be interesting to get his thoughts on some of the stuff you said. One kind of question, somewhat related to Turkey. What are the other countries where you're seeing just, huge discrepancies between fundamental asset quality and price? I know I feel like I've heard you mention South Korea before, but what are the other countries that screen well for you in terms of just, places where, things are not as picked over?
Well, I find the whole world is very heavily picked over, so it's
Interesting.
difficult to find. I think that um, I haven't found any market with the characteristics that Turkey has. I think that's a very unusual situation. Who knows how long that'll last? Uh, Korea is always cheap, and I think one of the big challenges we have with Korea is that their birth rates are now well below even China. And so, we need couples to have 2.1 kids to keep population at break even. Korea is actually alarming. It's down to 0.7 or zero point 0.8. Japan is at 1.4, and they have a declining population. So the Korean population decline, quite frankly, is alarming. It's going to, and that's a very strong headwind in investing in any country if you're going to see negative population growth. And China also is facing that, and it's a serious issue even in China. But Korea, out of all of them, between China, Korea, and Japan, Korea has the most extreme problems with the birth rate, and they're trying to press a bunch of levers. It's not working very well. In Japan, there's been an attitude change towards immigration. They're trying to bring in more people, and I think all three of the countries, in the long run, I mean, this is one of the huge advantages of the United States. The United States is the only developed nation which has population growth. No other developed nation has that dynamic, and we've had that dynamic for a very long time, and we still have population growth going on today. And I wish Congress would get its act together and fix immigration and so on, and continue to get the best of the world coming into the U.S. But yeah, so I think for a lot of the China, Japan, Korea, especially Korea, that's a big headwind.
So speaking of China, the last time we chatted, you were bullish on Alibaba. I don't know if you at the time had a position in it or not, but I think you may have.
Yeah, I switched the Baba position to Process, which is basically a 10-cent bet. I had studied Baba, and then after that I studied Process. I actually studied 10-cent, and I just found there was a big difference in business quality and leadership. And so we had a loss in Baba, and so instead of taking the tax loss and buying it back, etc., I took the loss and just switched it over.
And you've kept your position?
Yeah, for the most part, yeah, we kept the Process position.
Have you noticed just on Baba, like any sort of change in approach, just given kind of all of the stuff that's gone on in China over the last year?
Well, I think a number of things with Baba would, in my opinion, for me, would fall into the too hard pile. So it's very hard to handicap, what the CCP does with them. So I think 10-cent is a little bit different in the sense that they've always been they've been very cooperative with the government. They've had very great relationships with the government. And I think Baba, for the most part, from what I can tell, has fixed a lot of those issues. But I don't believe their relationships with the government is as good even today.
Yeah. The other thing that's interesting is India. So have you looked at, so Guy's invested in India Energy Exchange, Care Ratings, and he was talking about because I asked him about corporate governance, and what he mentioned was that it's highly regulated, and so are its counterparties. I know in the past you've said India has been difficult for you to invest in, and I'm just curious if you have any new thoughts on.
Well, we have an investment in an Indian Energy Exchange, and I think we own like 1 or 1.5% of the company. And I think it's one of the highest quality businesses I've seen anywhere in the world. Um, Extremely good management team, very creative, and extremely good execution. And even when I bought it, I mean, one of the things, the sad thing, like Ferrari, is that before the pandemic, I owned 4.99% of Indian Energy Exchange, which is the maximum the government allows foreign investors to own. And I paid up. I paid up significantly, 30, 40 times earnings for that stake because the business quality was so high. And so today, for example, about 8% of all the power that is consumed in India is going through IEX. And approximately 1% of the value of that power is their fees, their revenue. And about 70, 80% of that is just drops the bottom line. So that 8% of power that's going through is probably going to end up somewhere between 15 and 30%, 15 and 25 and 30% of the entire country. And India's per capita power consumption today is really low. There's the movement towards EVs and all of that. So I think power usage will go up a lot in India. It will go up. So Indian GDP is expected to grow up like 6, 7% a year. Power might grow up 8, 9% a year over a relatively long period of time. And with that type of growth, with a complete monopoly position where they are at 8% of the pie today, and it becomes 25% or something in 5 or 10 years, that's an exceptional business. They started a second business, the Indian Gas Exchange, which really shocked me in terms of their traction. So they just started the gas exchange about 2 years ago, 2.5 years ago. And now they're hitting some months where 5% of all the natural gas consumed in India is running through the gas exchange servers. And already, even though that business doesn't have the scale of the power exchange, something like 2/3 of the revenue is net income, pre-tax.
Wow.
And that 2/3 will probably go to 80%. And Guy, when Guy talks to them, I think Guy and I visited them last year. Was it last year? I think that's when we visited. So Guy's telling them, is there a way you can hide the profits? Is there a way you can not show the profits on your income statement because your regulator can see them, and you can see what kind of amazing mousetrap you're running. And of course, they're not going to do anything of the sort. It's a very high quality team. And but that's Guy's biggest worry, is that all the economics are visible. But the thing is, I think that the regulators really love IEX and IGX, and they really look at it as a national asset. And I think that part of the reason they do so well and they put so much to the bottom line is just how well the business is run. And I think the regulators understand that under different leadership and ownership, they would not have those numbers. And so it's just a really good business. And yeah, I am looking at it again to see if we should increase our stake. I think the gas exchange, they are being forced to divest their position down to 25% in a couple of years, 2-3 years. And so they'll do an IPO of that. And the market cap of that in a few years is probably going to match or exceed what they have for the whole business.
Have you been following this fiasco with the Adani Group?
Oh yeah, sure. Yeah. Indian mutual funds, by and large, other than the index funds, don't own Adani, don't own any of the Adani companies, even though it's a very large portion of the market. I don't know any investors, value investors, any investors I interact with in India who've ever had any stake in Adani. So, I think.
Is that because of his reputation, or just or valuation, or some other
Well,
reason?
I mean, I think that it's clearly optically and otherwise it's very expensive. It's always been expensive. And so it's difficult to justify those numbers. And so even the Hindenburg report, they start off, the first thing they say is valuation,
Yeah.
and they bring up a bunch of other things. Now, I have no idea, how real or not real those other aspects are. It is true that the quality of the businesses and the quality of the assets they own is exceptional. They own most of the private airports in India, ports, and a lot of the petrochemical infrastructure, pipelines, transmission lines, and so on. These are really very high quality assets. But the questions are swirling around the rest of it. And so I don't need to have an opinion on 98% of what goes on. I only need to have an opinion on stuff that we were actually going to invest in. So it's really irrelevant from my point of view. We'll buy some popcorn and watch the movie.
Yeah. As far as just following up on kind of our previous discussion, you've always been a big fan of Jeff Bezos and Andy Jassy and all of that. Have your thoughts on Amazon changed at all over the last year?
I mean, I think it's probably the most exceptional business ever created in the history of mankind. It's an amazing what they have put together and so I think the DNA of Amazon is just an incredible DNA. And under Jassy, I've always not liked their retail business where they take ownership of the products. That business, I've always hated retail and stuff. And he seems to think like that too. He's not a big fan of that business. And I think it's easy to not be a big fan because when you look at the numbers, they're not look that great. But other aspects of the business where they're doing fulfillment and advertising and all of that, those are great. And so I think Amazon, I mean, to think about a business which was a consumer commerce business, to have this massive footprint in enterprise core web infrastructure, that's a big leap. Okay. And they made that leap and they, ran circles around everyone else. Amazon is the kind of company where you don't even know what businesses they'll spawn and be in 10 years. And that spawning engine is very much alive and kicking. So I think under Jassy, he's going to de-emphasize the businesses that, have lower returns on equity and all of that. And I've even now seen they're looking at buybacks and things where they're actually starting to generate more cash than they need. So incredible business. And like I said, I've always been too dumb to buy it, and I'll probably be too dumb to buy it forever. We'll see.
Well, so I was going to ask. I mean, the stock's obviously struggled for the last 2 years, and it's not at its lows over that period, but it's certainly got a long way to go before it gets back to its highs. I mean, do you have a price point in mind where you would potentially take a position?
One of the mental blocks I have, which probably hurts me more than it helps me, is the law of large numbers. So when I look at businesses, 500 billion, trillion, 2 trillion market caps, which are the highest they've ever been for any business in the history of mankind. And then when I look at, how many businesses, large businesses like that survive for 100 years, 50 years, and that sort of thing, the death rate is really high.
Right.
And these companies, if you look at a business like Apple, I don't think I can see anything on the radar that's going to affect Apple for 10 years. I think it's just a great franchise. It'll keep going. I don't know if I can make that statement for 20 years or 30 years or 40 years. I can make it for 10 years. But when you're trying to buy Apple at the 2 trillion, whatever it's at, you need to have a view 15, 20 years out. You need to have some view on that. I mean, I know that Ferrari will be cranking 15, 20 years from now. I know Hermes will be cranking 20 years from now, 40 years from now, 80 years from now. I was having a discussing with Charlie a few months back where I told him that, if I look out 100 years or 200 years, I think the railroad in Berkshire will be intact and doing great. Even if we get to maglev or some new technology, the right of way and the need for humans to move goods, that's probably the most efficient way to move goods. So that moat is almost a indestructible moat. And I said most other things I see in Berkshire, I don't, I can't make a comment that 100 or 200 years from now they'll still be there. And Charlie corrected me. He said, "Well, our power business is pretty good too." And he's right. Yeah, the utilities and power business that they have is another amazing business. And again, that's unlikely to change, in terms of how we get our electricity and power and all of that. And so, but insurance, Apple, uh, a whole bunch of other businesses, Seas Candy and others that Berkshire is in, hard to make a statement that they'll be around 100 years from now. They will maybe, but I don't know. And so when you get to these large, very large market caps, this is the issue that bothers me, is that, you look at something like LVMH, huge market cap. I would say someone like LVMH has a much stronger chance of being with us 50 years from now than Amazon does. Even though Amazon looks just totally dominant today. So my take is that when I get to some of these really large market caps, is really, and Tencent was an exception for us, is to really go back to trying to find the next compounders at smaller market caps that can get long runways and get there. So that's kind of where I end up.
You'd put Microsoft in the same bucket as Apple?
No, I think Microsoft, between the two businesses, I'd be more interested in Microsoft than Apple. And one of the reasons is that, so if you think about the iPhone, it's actually a very kludgy device. And this is kind of where Mark Zuckerberg is going to. So the iPhone, most of us don't really particularly care about the phone part of the iPhone. That's really irrelevant. It's really a computer we carry around, right? And if I'm using it, to map where I'm walking to or where I'm going to, it's kind of a kludgy thing to have this thing in my hand or whatever, or have directions being fed to me in my ears or whatever. So I would say that the human factors in the long run of how we interface with technology, which is we get to your favorite subject, the metaverse. Is, I mean, there is a unpredictable direction that we will be heading to at some point. Okay. And when we head in that direction, it is a big unknown where Apple fits in. Okay. It may well fit in and it may not fit in. We don't know. I know at some point this technology of all this stuff, a lot of it goes into the cloud, some of it is with us, and some of it becomes wearable or whatever else. Where that whole thing sorts out is unknown. And that's why I say we don't know 20 years from now. Microsoft's business is a lot more enterprise driven. And so to me, that has more resilience than a purely consumer driven business that Apple has. And Apple has a lot of goodwill amongst the consuming public, a lot of trust, great brand, but it doesn't have the same kind of nuance with, all those companies in the App Store giving them the 30% and all of that. So there's animosity with that group. And Amazon, for example, doesn't have that animosity. All the enterprises that work with Amazon don't have a negative view on the company. A lot of the App Store developers believe that the 30% is too high. And they think for what they add was what Apple adds, So that part of the business is not a win-win in my opinion. I think their take rate is too high. And on the consumer side, they do a great job. So um, Apple's a great business. I think 10 years, like I said, I don't see anything, might be doing well in 20 years, but I wouldn't want to make that bet.
Mohnish, before we close, you'll find this interesting. My wife is going to be talking about inflation. She's the head U.S. inflation strategist at J.P. Morgan, and I was going to ask you. We live in a world right now where there's just enormous geopolitical risk, and macro has just absolutely dominated the markets over the last, really for the last year. I mean, all of 2022, I feel like was a write-off thanks to the Fed. For all of us who are not invested in Turkey. So I was curious, do you have any views on where inflation is heading, how quickly it might be contained? I don't know if you have thoughts on wages, which is a big sort of part of the problem in terms of just being stickier than other parts of um, inflation. I'm just curious if you had any macro thoughts for us on and if any of it keeps you up at night.
Yeah, probably not my strong suit, but I would just say that we've got a great central bank, an independent central bank. They may not always get everything correct. They may undershoot, overshoot, all of that. That's part of the deal. But I think they will look at the data, and for the most part, they'll act prudently. So I think over time, we'll get to where we need to get to. And I don't know if that happens in 1 year or 2 years or how long that takes. But the U.S. economy, surprisingly, with all the amount of money that's been pumped into the economy, the inflation is still pretty benign relative to all that. The unemployment rate is unbelievable. It's the economy is cranking really well, and it's still firing on all cylinders. It's a great engine. I wouldn't have predicted all of these things given where we are coming from, but here we are and we're doing great.
You don't foresee any sort of recession coming anytime soon, it sounds like.
I would probably be a really bad person to make those types of calls. I never saw 2008 coming easy either. I did see the bubble in 2000 before that happened, so I was able to sidestep that one. But I took the full brunt of 08, 09. So yeah, I'm not a good guy on that front. I don't know where things end up on that front, and I'm trying to make bets where those types of events don't have that much impact. I mean, I think that's why I have an interest in things like IEX, and I have an interest in things like Reysas and TAV, and the Coke bottler and so on. So I think those are more interesting to me because I don't have to think about these things too much.
I think it's a fair point, Mohnish. This was great. Super interesting as always to hear your thoughts on the world and obviously your portfolio. We'll certainly follow up regarding the Turkey donations. But thanks again for your time, and looking forward to chatting again soon.
Likewise, it's always fun, Divya and Guy. Thanks for attending.